From the morning reading, Spiders, Diamonds, continue day 3 bull flag. 4 of 9 sectors moved higher on Monday. XLP, XLU, and XLY were the strongest sectors, while XLE was the weakest sector. While futures fell 76 cents to close at 42.99. Breath weakened as decliners led 2.02 to 1 on the New York Stock Exchange and 1.62 to 1 on the NASDAQ. The Spiders and Diamonds are in day 3 of a bull flag price pattern and both formed a hammer candle pattern on Monday. Watch for a bounce as soon as Tuesday, potentially. The big money is apathetic. The latest Barron's Big Money poll of large asset managers showed a large number of bullish responses, among the lowest since at least 1999. These managers' history as a non-contrary indicator is mixed, and it's not always a good idea to assume that big money equals smart money. For the most part, when they are highly apathetic, stocks tended to rally, but that's a tenuous conclusion. Small traders are apathetic too. That at least, that according to 2 longer-term measures for which the largest and latest data show extremely defensive activity among small traders. This is unusual given the rally in stocks since February, and it's in conflict with many other indicators we follow on the site. There's no good way to reconcile this other than the sentiment situation is less negative than it could be if these indicators were more in line with their historical behavior. The FOMC updates its thoughts on Tuesday. Over the past year, stocks have shown minimal downside in the day before and day of the Federal Reserve's interest rate meetings. Over the course of 8 meetings, Spider's worst drawdown from Monday's close through Wednesday's close was minus 0.6%, and it showed a positive return 7 of the 8 times. The best performers were XLB and XLE, positive all 8 times, while the losers were volatility and bonds. After the meeting, stocks struggled, with SPY showing a positive return over the next 7 days, only 2 times, and both were minimal. The worst performers were gold stocks, while the best were bonds. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:53 a.m. Central Time, and I'm recording this in preparation for the market day of April the 26th, 2016. Remember that on YouTube, you can have a free subscription to the channel and be alerted to new content being published. Give the video a few minutes after being published for the video to be available in high definition. Click on the setting button to choose the high definition playback level. In this same area, you can also control the speed of the playback. I routinely find that I can fully understand videos at about 1.5x the recorded speed. Also note, full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And not much to comment on here. All 4 of the U.S. broad market indices are up, though really only the Russell's up, enough to really note at about 1/4%. The crude oil is up about 0.75%. Euro is up just above scratch. Bonds are down just below scratch, and gold is down about 0.4%. In overseas action, it's pretty mixed. China's up about 0.6. Hong Kong's up about half. Japan's down about half. Germany's right at scratch, and the United Kingdom is up about 1/3%. In terms of macroeconomic reports for today in the United States, we have, of note, consumer confidence. And then looking forward to tomorrow, we have pending home sales, the weekly crude oil inventories, the FOMC statement, Fed funds rate, and that looks to be about it. So obviously a lot of people are talking about just getting to these minutes that will be happening and just kind of get some insight. Nobody is pricing in any expectation that the Fed funds rate is going to change at all anytime soon. In terms of market conditions, Short-term VIX 13.62, skew just above the warning threshold at 126.78. IV percentile, all very, very, very low. SPX is at a 10, the Russell's at an 11, the NDX, NASDAQ is at a 14, the Dow is at a 7. No standard deviation moves were put in yesterday on a close-to-close basis on any of the U.S. indices. And really nothing terribly remarkable in the amount of volatility that we've had in the last 2 weeks worth of trading activity. In terms of current charts, let's go ahead and take a look at that. Right now, it just looks like, as one of the morning authors indicated, something of a bull flag pattern with an expectation that, you know, something just above this would trigger you to get back in long for the next leg. So nothing really fearful at this point. I think even one of the indices had a golden cross, though I can't remember which one the morning reading was referring to on that. Here's the Dow, also, you know, setting up for a classic bull flag pattern as it would appear right now. NASDAQ, a little bit weaker than the others. And Russell, nothing really to get excited about in chart patterns on any of these. We did mention yesterday, and we'll continue to reiterate that, you know, these are all up against significant resistance zones, but, you know, haven't shown any significant reason to drop as of yet. Bonds continue to drop, which should mean that equities are going up. Let's look at volatility. Volatility not doing anything particularly exciting. Right now, it looks like today could be very quiet, which would not be surprising given that we have Fed minutes. So there probably won't be a very large range to today going into those Fed minutes and Fed decision. And let's take a quick look at gold. Gold continues to be quite sloppy. Their expectation is that gold could break long at some point here, but it's a really, really messy pattern here, and not giving any obvious signal as to when you might want to step in. Not yet. Okay, let's go ahead and go to the daily report. And let's see, I think, yeah, there was one change in the decision point scoreboard. So of our 3 mechanical signals, one of them had a change. We are still, I should say, in the market trend intermediate term phase opinion phase 4, which is that bullish price pattern typical of being near horizontal resistance. Of the 3 market timing signals, the first one uptrend under pressure from IBD, so that one is a caution position. Accumulation distribution score for the NASDAQ is at a B minus, the S&P at a B, so fairly benign there. GMI index is a 5 out of 6, so still holding up with the buy signal there, though the GMI 2 is at only a 3 out of 8. That's the more sensitive indicator, so that one's giving perhaps a bit of a warning sign. Another warning sign comes from the third mechanical signal, and that is from the decision point scoreboard from stock charts, and we had a sell signal come in on the short term S&P 500 and the short term Dow. So a couple warning signs there to join what had come in just a few days ago on the NASDAQ as a short-term sell signal. So again, we start to see this really mixed stack between the short, intermediate, and long term, and we've got very mixed signals now on both short term and on the long term, though the intermediate term is still all in alignment. This overall, though, gives us something of a market in transition and a very, very mixed picture going forward. In terms of position sizing opinions, the one signal is at 50% on portfolio. In terms of active trader, the volatility signal is at 75 to 100%. In terms of intermediate term market posture, we're still very strongly bullish, though not nearly as much so as we were. You see several of these have dropped below 90, but anything above an 80 still retains that very strongly bullish posture. Also note that this is supported by a very strongly bullish sentiment line that is up in the upper reversal zone. In terms of the strength of the trend, it's currently a very strong bullish trend. We're up over 80. And the hedge warning status is at level 1, which is our yellow light. We think of it as a cautionary stage. So this is not normal. We've got some reasons to be elevated, and yet at the same time, this isn't all out hedging. This is mostly a preparatory kind of stage. In terms of special opinions, no changes from yesterday. Option income strategies, covered call strategies, put selling are all in fairly bullish postures and opinions at this point. We did have a couple new warnings come into play yesterday, and the volatility bucket, market and decline and sharp increase warning have both now flagged. That joins another warning that's already been in place. The volatility ratio warnings in the upper reversal zone. We're waiting for a close back inside the window. Note the distribution day count still is at a 6 for the NASDAQ, a 5 at the S&P. We did have that skew come in at just over 125, which gives us about a 9% probability of a 2 standard deviation move within the next 30 days. In terms of other indicators showing risk or increased volatility or risk conditions, really nothing to get excited about. New highs, new lows were all relatively benign. Intermarket risk aversion indicators are actually supportive of risk on at this point. In terms of sentiment, nothing really extreme there in any of the sentiments. We do have some individual ETFs that are extreme sentiment, so you're watching for potential reversal patterns if you're trading in any of these markets here. In terms of the fear and greed index, this final sentiment indicator, which is a compilation of 7 different metrics and is rolled up by CNN Money, you see that's actually ebbed off a little bit, so put a little bit of distance from this upper quartile. In terms of intermediate term market postures on these various ETFs, it's still a strong mix of defensive and more aggressive, so that continues to support the bullish case. In terms of sector specific, our percent change, you notice that we've got some weakness in retail, technology, utilities, consumer staples, and to some degree in transportation. So a bit of a mixed bag here. There's been something of a rotation that's been going on. If you look at who the performers were 3 months ago versus who the performers are at this point, there's been some rotation evidence coming away from utilities, from the consumer staples, and from telecom towards some of the higher beta areas. So continue to be mindful of that occurrence. If you're in some of these positions, you might be wanting to protect some of your profits and perhaps shut those down and move towards some of these other areas if this movement and rotation continues. In terms of yesterday percent change, you do see those very markets were the ones that held up, the consumer staples, telecom, utilities. So again, this has not been an easy rotation to follow, but we continue to see this, the 5-day though. While we had these do well yesterday, the 5-day, you have utilities down still some 3.37%, whereas over that same time frame, you had financials, healthcare, materials, energy. They're the performers in the last week. So we continue to see something. Look at the 1 month also. So those same 3 in the 1 month are also down, whereas these others are performing. So there does seem to be something of a rotation going on, and you want to be mindful of that if you're in some of these positions. Rotation between these sectors in the last, from November of 2014, when we've been in this large broad range has been relatively quick. It's not been something where you can pick a sector and just sit there for month after month after month. We've seen this over and over again where, what's in favor literally, 1 month is at the bottom the next month, and what was at the bottom is back to the top. And then very quick rotation from the top to the bottom and back to the top in many of these sectors during this broad range-bound activity that we've had for quite a few months now. So this has not been an easy market for sector rotation investing, is the bottom line to it. And you certainly can't just sit there and watch it without any kind of effort. And that should be enough for today. Let's go ahead and go to our wrap-up sequence. I did mention during the beginning sequence about being able to subscribe to the YouTube channel, and I'll just give a couple comments about that. There's a little playback button, call it the gear, to access the settings on YouTube, and that's the one that you would change to be able to make sure that you're watching in high definition. If you are subscribed and you respond immediately and start to play it back, you'll notice that it probably seems a tad bit fuzzy. So if you'll wait once that content is posted for a couple minutes, you'll see that that playback will be available in high definition. Certainly when you get to where you're playing it back, make sure you are watching it in high definition, be able to have greatest clarity on the charts, etc. The other thing is that you might want to make sure that you're listening to the playback speed at about 1.5. Most of the time people can fully understand what's being said, and yet at the same time cut down the time impact on their morning preparations for the market to open, take, say, about a 20-minute video down to 13 minutes. So something to be thinking about there. Other opportunities, just hit the pause button if you'd like to explore something more. Just hit the hyperlink or put that hyperlink into your browser to be able to get additional details. I believe there's a video even available on the daily price guide subscriptions. Fantastic tool for day traders. Other opportunities. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and you see the hyperlink at the bottom for the full set of disclosures. We'll see you back here tomorrow morning for the Falcon Global Market Preview. In the meantime, good trading.